Let's take some time and talk about accruals, deferrals, and adjustments. See, what happens here is that accounting systems are really good at recording daily transactions. Cash in, cash out, purchases, payments to employees, things like that. But as we know in our study of accrual accounting, cash is not always received in the same period when the revenue is earned, when the revenue will be recognized on the income statement. And cash is not always paid in the period when those expenses are incurred, when those expenses are recognized on the income statement. That's one of the beauties of accrual accounting. Accrual accounting allows us to measure revenues on the income statement when they're earned, even if the cash flow occurred before or after that period. The same is true for expenses. We can recognize expenses on the income statement when they're incurred and match them to the related revenues, even if the cash flow happened before the month, after the month, before the year, after the year. So adjustments simply take accounts from the balance where they are to the balance where they need to be. Adjustments are needed at the end of the period to update account balances on both the income statement and the balance sheet to what their appropriate balances should be for that particular period. Remember this unadjusted trial balance. You may have seen this in a previous video. We've got our accounts. As a reminder, the trial balance is simply a listing of the accounts and whatever their balances are at a particular point in time. This happens to be the end of February. February was our first month of operations for this coffee house. And you may recall that we ended February with $16,900 in cash, and we had $10,700 in accounts payable. And we had some revenues and we had some expenses. All of those are the result of cash transactions. We need to make some adjustments now because you'll notice there are some zeros here. Look at all these current liabilities. There's nothing in them. Accumulated depreciation, which we've pretty much ignored to this point, still has a zero balance. No cost of goods sold, no rent expense. That's a little bit unrealistic. How about depreciation or interest or income taxes? And yes, this is a very abbreviated example, but what I'm going to try to illustrate to you is that the adjusting entries will allow us to take these zero balances and convert them to amounts that are more appropriate to measure the results of the operations for the month of February and the financial position of the company as reported on its balance sheet at the end of February. Take a look at our inventory account, for example. We have $600 listed in inventory. Without any adjustment, that's the amount of inventory that will be reported on the February 28 balance sheet. But we have no cost of goods sold. Remember, cost of goods sold is an expense that's reported on the income statement. It really represents the cost of the items that we sold. So what we need to do is we need to make an adjustment. This is the inventory account in terms of a T account. And just to give you a little reminder, here's our, I call it a cheat sheet. By now, if you've watched enough of these videos, you should start to have dreams about this at night. You might call them nightmares, I'm not sure. But just remember that an asset is normally a debit account. So when we see a debit balance asset, that's a positive asset. And if you see a credit balance asset, that's a negative asset. Expenses behave the exact same way as assets. Normally a debit. If it's negative or if we're going to reduce an expense, we need to make a credit entry to that account. Now, once you remember that assets and expenses have the same debit-credit behavior, you know that liabilities, owner's equity, and revenue all behave exactly the opposite. I think that's a wonderful way for you to help get through some of the debits and credits that you might see on an exam or a homework problem. Use this as a tool. So right now, this T account shows inventory with a debit balance of $600. If we were to prepare a balance sheet right now, as of the end of February, that's the amount of inventory that would be recorded on the balance sheet. And by the way, remember, inventory is an asset that is reported on the balance sheet, whereas cost of goods sold is an expense that is reported on the income statement. But $600 isn't the truth. Some of that inventory is gone because we sold it. And what we really need to do is we need to take some of these dollars and move them from the balance sheet over to the income statement as cost of goods sold. Now, it's kind of convenient that assets and expenses have the same behavior. So if you want your inventory to decrease, what you're going to need to do is you're going to need to make a credit entry to the inventory account. So I'm going to abbreviate inventory right here, but by making a credit entry to inventory, notice how you're decreasing the inventory account. Now, for every debit, there needs to be a credit, right? That's one of the fundamental laws. So we're going to record an increase in cost of goods sold. Cost of goods sold, an expense, increases by $350. The effect of this journal entry is to, and let's just post it to the accounts here. The effect of this journal entry is to reduce inventory by $350 by moving it over to the income statement as an expense. After you post this entry, your inventory balance will no longer be listed as $600. It would be $250. And your cost of goods sold is no longer zero. It's a more realistic number at $350. Now, we're going to explore this in a lot more detail in a couple of chapters when we start to look at merchandising operations and the relationship between cost of goods sold and inventory. But for now, understand this. This $250 should represent the cost of the merchandise or whatever inventory items we actually have on hand at the end of February. And this $350 should represent the cost of the merchandise or the inventory that we sold. And that's why it should be an expense on the February income statement, even though this transaction didn't specifically involve cash during the month of February. You might recall if you watched a previous video that we had prepaid rent of $7,200. That's because during the month of January, we wrote a check to our landlord for $7,200, but it didn't really apply to the month of January. So what we're doing here is we're recognizing the fact that rent expense in this particular example is really $2,400 per month. And we need each month's income statement to report the appropriate rent expense for that month. So what that means is February's income statement should report $2,400 of rent expense. March's income statement should report the same, and the same is true for April. But right now, as you can see, rent expense for the month is zero. Prepaid rent has $7,200 in it. So what we really need to do is we need to take a portion of this rent expense, the portion that relates to February, and we need to take it out of prepaid rent, move it into rent expense. So as you can see, what's going to happen is prepaid rent is an asset on the balance sheet. We need to reduce the prepaid rent by $2,400. And rent expense is an expense on the income statement. We need to increase that. Now, I'm going to skip the actual journal entry here and just show you what the effect is on the T accounts for illustration. But the journal entry is going to do this. It's going to record the increase of rent expense by debiting that account in the amount of $2,400. And it's going to record corresponding decrease in prepaid rent. If we balance these accounts, when all is said and done, $7,200 minus $2,400, this prepaid rent account will have a balance of $4,800, and the rent expense account gets converted to $2,400. So what you're seeing here is a depiction of reality. During the month of February, we consumed rent expense by occupying the facility where we run our restaurant. It's only appropriate that the month of February reports an expense of $2,400 of expense for rent, even though there was no cash payment for rent during the month. The cash payment in this case occurred before the beginning of the month. So now the February income statement will have rent expense of $2,400, and the balance sheet at the end of February reports exactly what is the truth, which is we have 2 months of occupancy available to us, and we don't have to write another rent check for a couple months. What's the value of that? Well, the value is $4,800 because we can stay in this facility for March, we can stay in it for April, and we've already paid that expense. That's an asset. That is an economic resource that the business can use. we need to record depreciation expense for our coffee house. But before we do that, I want to spend a little bit of time with an overview of depreciation expense. Because if you're like a lot of students, this is a foreign concept to you. And it's a very fundamental concept when we're talking about long-term assets, such as this airplane that we're going to use for an example. And in a future discussion, we're going to go through depreciation expense in a lot greater detail. But for now, let me just kind of illustrate it this way. Now, depreciation is not a valuation method. You might think about depreciation like this. Oh, I bought a brand new car, and as soon as I drove it off the car lot and maybe used it for a month or two, the value of that car decreased. And that is true. From an economic perspective, the value of the car did decrease. But that's not what we're doing with depreciation, even though that economic loss of value is probably the context in which you've heard the term depreciation before. In financial accounting, depreciation is really a cost allocation method. Take this airplane, for example. Let's pretend that I wanted to use my airplane to run a charter airline service, a little charter airline. And a common depreciable life for airplanes is 5 years. I've chosen that as well because the math is kind of easy. So think about it this way. We've purchased an airplane. Let's say we spent $100,000 to buy this airplane. That should not be an expense solely in the period in which we paid for the airplane. What it should be is it should be an expense recognized over a period of years as we use this asset to generate revenue. In this case, when passengers pay us to fly them certain places. So what we have to introduce here is this concept of a contra account. A contra account is any account that has a balance that is opposite the normal balance of the regular account. So with this particular asset, we may have the airplane's cost recorded in this equipment account. Remember, equipment is an asset, so it has normally a debit balance. So we've got a $100,000 asset on the balance sheet. As we allocate that asset to future periods, what's going to happen is the net book value of this asset will decrease. Anytime we see the term net, what we're really doing is we're combining at least two or more accounts. And what you're going to see is going to happen as we record depreciation expense periodically. Instead of directly reducing the asset account with a credit, we're going to reduce the net asset reported on the balance sheet by crediting this contra account. Now, at the end of this airplane's useful life, assuming that we don't assign a residual value to it, which is a discussion for a future time, at the end of this asset's useful life, the accumulated depreciation account will have a credit balance of $100,000. So we have an asset account and a contra asset account, and after 5 years, this airplane, even if it is still in our possession, even if we're still using it for our business, will have a net book value on the balance sheet of $0 because the asset minus the contra asset will equal $0. Here's an excerpt of the balance sheet for Harp Air LLC. We have some cash and accounts receivable and whatnot, but here's the airplane. Non-current asset, so the equipment balance has a positive balance of $100,000. Note that this is a beginning balance sheet, newly formed entity maybe, or at least a young entity. So right at the beginning of January, we bought this airplane and it has a net book value of $100,000. What we're going to see over the next few iterations is we're going to record depreciation expense for the next couple of years, and you're going to see this accumulated depreciation grow. It grows like a snowball. It's a negative asset, a contra asset, that will iteratively reduce the net book value on the balance sheet. Think about it this way. Now, this could be a little bit dangerous because I'm about to tell you that we're going to record depreciation expense for the first year in the amount of $20,000. Well, how did I come up with that $20,000? What I'm basically saying is the depreciable cost of the asset is $100,000. That's what we paid for the airplane. And as management, management of the company, we estimated that the useful life of this asset is 5 years. What that means is that we're going to record depreciation expense equal to $20,000 for each year. Does that mean that the asset will be completely worthless after 5 years? No. What it means is we have a compromise happening here. And there are plenty of compromises that happen with accounting estimates. Will the useful life be exactly 5 years? Probably not. It's management's best estimate. And even if this asset has value, fair market value at the end of 5 years, we've presented this in a conservative manner, certainly. Now, even if it's not used up after 5 years, it could be that this asset will require some significant investment in overhauls or upgrades to keep it in an operating condition. So think about it this way. We're not really using up an entire right engine of the airplane, but you can kind of conceptually think about it that way, is that we're allocating a portion of this $100,000 cost to the income statement. So we record a depreciation expense entry that reduces the asset's net book value by $20,000 and will increase depreciation expense on the first year's income statement by $20,000. Asset goes down, expense goes up. So we record depreciation expense of $20,000 for the first year of operations with this asset. Notice that this balance sheet excerpt is now the end of December for 2017. So the end of 2017, what we own and what we owe at that point in time, and what do we own right now. I chose to keep things simple, and I left the cash and the accounts receivable static. That's really not realistic. Those things would change as you run your business. But I did that because I really want us to just focus on this fixed asset section of the balance sheet. And notice now what happened. Okay, we've got the equipment account, and I'm just going to put a T account here just to kind of illustrate. The equipment account still has that $100,000 balance for our cost. I'm going to abbreviate accumulated depreciation with AD. And what you see is now the accumulated depreciation account has $20,000. Where did that come from? It came from depreciation expense that we recorded on the 2017 income statement. So the journal entry for that end of the year was actually debit depreciation expense $20,000, credit accumulated depreciation $20,000, accumulated depreciation because it's a contra asset account. Notice that, remember, an asset account, if it has a credit balance, it's negative. And that's exactly what you're seeing right here, is this contra asset is reducing the net assets on the balance sheet. We would call this $80,000 right here net book value. Okay? And the reason it's net book value is because the balance sheet is our company's books, and the term net really refers to the fact that we're combining two accounts, the $100,000 and the negative $20,000, to arrive at a net amount at which this asset is reported on the balance sheet at the end of 2017. Now we're into the next year, and again, we're not consuming this asset. We're not using it up. The left engine is not going away. What I'm really trying to illustrate is how we're taking this $100,000 asset and we're taking that big cost that really benefits a number of years. We're going to be able to use this asset for many years, and we're trying to just allocate this cost in chunks to individual years, the years in which we will earn revenue from using the asset. So again, what's going to happen is we're going to record a journal entry, and I'll put the journal entry here now. Okay, depreciation expense, that's going to be recorded on the current year's income statement, $20,000. Expenses increase with a debit, and just like we did the previous year, accumulated depreciation is going to have a credit entry. And when we do this, what you're going to see happen is the accumulated depreciation balance is going to grow. Remember, at the end of 2017, accumulated depreciation was a $20,000 credit balance. Now, I know it's kind of behind the words there, but I think you'll get the point. Now, because of this second entry, accumulated depreciation has grown like a snowball to a $40,000 credit balance. And notice what happens. As we record each year's worth of depreciation expense, the net book value drops. In this case, from $80,000 down to $60,000. We're not saying that the asset is worth $60,000 at the end of 2018. We're just simply saying that's the net book value that is the result of our estimated allocation of this cost over the future periods. Let's continue on to the third year. Again, since we're using straight line depreciation, that means that the expense will be linear. It's $20,000 per year over the useful life of the asset. And just as a reminder, I know I've said this a few times, we're not using up the asset. Even though I've shown some portions of the asset going away, what we're really doing is we're allocating the cost of the asset to these future periods. So once again, in this third year, we're going to record a journal entry that increases depreciation expense so that that third year's income statement reflects 1 year's worth of depreciation expense, and the asset will be reduced again. And we can see that happening right here. The asset's being reduced because accumulated depreciation continues to grow. And it's a contra asset, a negative asset. It was $40,000 at the end of 2018. Now it's going to be $60,000 at the end of 2019. And that continues to make the net book value decrease from $60,000 down to $40,000. If we were to continue this example for 2020 and 2021, what you would see is the accumulated depreciation would grow to $80,000 and then to $100,000, and the net book value would drop from $40,000 to $20,000 down to $0. As I mentioned before, we're going to explore this concept in a lot more detail in a future session. But I wanted to give you an overview because we're about to take a look at depreciation expense for our coffee house. Take that depreciation concept we just explored and think about it in the context of our coffee house. Now, I'm just going to tell you that depreciation expense is $650 for the month. So what we're going to do here is let's, first of all, record our depreciation expense. As you might recall, that is an expense that will be reported on the income statement. Anytime we report an expense that is going to cause the period's net income to decrease. Greater expenses means lower profitability. And the other side to this journal entry is accumulated depreciation, as we saw just a few minutes ago. But in this case, it's $650 for this particular month. So what we're seeing here is that we're putting an expense on the income statement, but we never used cash for this expense. The cash was spent earlier when we purchased the furniture and the equipment for the coffee house. All we're doing now is we're taking the cost of those long-term assets and we're dividing them up among the periods that will benefit from those assets. So we take the $650 credit entry from the journal entry and let's post it to the T account for accumulated depreciation. Take the $650 of depreciation expense, post that to the T account for the month for depreciation expense. Now for the month of February, depreciation expense will be $650. It's a debit balance, that's normal. Accumulated depreciation will be $650. That's a credit balance, and that is normal. What I'd like to point out is this is a contra asset. Okay? Contra asset reported on the balance sheet. Yes, assets normally have a debit balance. That's if they're positive. A contra asset is really a negative asset. It's an offsetting asset. Contra accounts offset the normal balance of related accounts. So equipment would be the normal account with a debit balance. Accumulated depreciation is the contra account that offsets that asset account. You may recall from a previous discussion that you purchased a $300 gift card for your favorite accounting professor. And when you did that, the coffee house received your cash, they have custody of your money, but they really didn't do anything to earn any revenue during that time period. What they had was a liability here. They owe somebody some food and beverage because that's what the nature of the gift card is. Well, let's say that your favorite accounting professor takes a few students over to the coffee house and we buy $100 worth of food and beverage. Let's take a look at how we would record this entry. Now, if you look at this little cheat sheet I have, you know that for a revenue account to increase, we need to make a credit entry to that account. So we've got beverage sales, one of our revenue accounts on the income statement, we're going to need to make a $100 credit entry to this account. Now, the corresponding debit could be one of a few things. Let's explore that a second here. So I'm going to put the journal entry here. And if you ever find yourself having difficulty completing a journal entry, start with what you are certain about. Because there's usually one element of the journal entry that you can really wrap your arms around and be certain about that. And in this case, I'm very certain that the coffee house earned $100 worth of beverage sales revenue. Okay? Took favorite students out for coffee, and the coffee house earned that revenue because they sold merchandise. They sold product to somebody. Now the question is going to be this. You know that the total of your debits has to equal the total of your credits. So if we've made a credit entry to beverage sales for $100, we need to credit one or more accounts, or we need to debit one or more accounts for $100 here. The question is, what are we going to debit? Well, if there had not been a gift card, probably what would have happened is the accounting professor would have paid cash and the coffee house would have seen their cash increase. But that's not necessary. The coffee house already has the cash. So instead of an asset increasing in this case, what's really going to happen is a liability is going to decrease. Deferred revenue is a liability on the balance sheet. So what we're going to see happen, instead of asset increasing here, we're going to let some of that liability go away. So now see what the effect of this journal entry is. The $100 debit to deferred revenue is going to get posted to the account. Now the deferred revenue liability is only $200 because $100 of that gift card was used. We now only owe $200 of food, beverage, other products to the holder of that gift card. And simultaneously, what's happening here is we're recording our sales, okay? Sales revenue. So this is a perfect example of recognizing revenue during a particular period when we earned it as part of our operations for that period, even though nothing affected cash. It was a non-cash account that was affected, in this case, a liability decreasing. Now we get to sell some food and beverage to our customers, and we need to record that entry. So let's assume that the beverage sales in this particular transaction are $1,500. Now, for the next few transactions, I'm actually not going to show you the full journal entry. I'm going to show you the impact of the journal entry. But you know by this point that we would first have to record this as credit, debit in the form of a journal entry. I really want you to focus on the impact of what's happening in the financial statements. So we record these beverage revenues, $1,500, and we also sold $1,000 worth of food. Now, a lot of times a coffee house will just receive cash, okay? Or maybe like we had the example with the gift card. But let's say that this particular coffee house has a contract with a local office or university or something like that to provide some catering for their meetings and events. So what we're going to see here is instead of receiving cash, we have this asset called accounts receivable that's going to increase. As a reminder, accounts receivable is an asset that is listed on the balance sheet. Beverage and food sales, these are really, both of these are revenue accounts that get reported on an income statement for a particular period. Okay? We choose to separate our revenue into two different accounts because we think that's meaningful. So what's the impact of this transaction? Accounts receivable is an asset. It's increasing. It's going to go from $500 all the way up to $3,000. And what that really represents is our customers at the end of this period, or at least at this point in time, owe us $3,000. We have the right to receive $3,000 from them. Okay, that's an economic resource. Our revenue in beverage sales for the period used to be $5,100. Now it's going to climb to $6,600. And the food sales revenue used to be $7,000. It climbs all the way up to $8,000. Okay, so let's look at the calendar for a minute. And if you want to, go ahead and pull up a 2018 calendar. and you will see that February 28, 2018 is a Wednesday. So the end of this month that we're trying to report for our operations is a Wednesday. Now the reality is, most of you watching this video, you have had jobs, you receive paychecks, and you probably get paid weekly, maybe every other week, maybe twice a month or something like that. So what this really means is, from the coffee house's perspective, if the end of the month is a Wednesday, we've got a few days where our employees worked for us, but they may not get their paycheck until early March, maybe like the next Friday or something like that. So at a minimum, we probably have Monday, Tuesday, and Wednesday where we have an expense that really should be on February's income statement because we incurred that expense. Even though we did not pay cash to the employees, they worked for us, we owe them money. So what we need to do is we need to record a journal entry to adjust both the wages and salaries expense, so this expense for the particular period, in this case, February, that expense needs to go up. And then, since we're not using cash yet, eventually we will use cash, we're going to record a liability on the balance sheet. You see how accrual accounting works. When we need to affect something on the income statement, we can use a non-cash asset or liability on the balance sheet to accomplish this. And then at the end of the period, we're going to record, we will have that liability. What do we owe to our employees? And we will report fully a complete sense of a picture of what were the operational costs of running this business. Now, we've got our little cheat sheet here. In the case of the coffee house, it is a corporation, so it would be stockholders' equity. But I just wanted to point something out. The reason I put OE, owner's equity, as you might know from previous discussions, a corporation is one form of entity, but there are also LLCs and partnerships. So I just generalize it OE. Plus, over the years, my students have told me that this cheat sheet is very soothing. It's like aloe, okay? I hope that helps you remember the debit and credit rules, or at least gets you through some of these problems. So what do we have here? We have some additional expense that needs to be recorded for this little stub at the end of February. And I'm just going to tell you that we've measured the cost of those few days as $1,200. So what you see here is we're going to make salaries and wages increase by $1,200. That means that this expense account will grow from $7,800 up to $9,000. Now, we're not going to credit cash because we didn't pay the employees in cash yet. Instead, what we do, our credit is to a liability. And that liability, salaries payable, I suppose you could call it salaries and wages payable, or some companies even call it accrued payroll. But I want you to focus on the concept here, is that now what we have is our balance sheet at the end of February will report the fact that we owe $1,200 to our employees. The expense for the month of February is more complete at this point. And we've given financial statement users just a little bit more information to help assess those future cash flows. If you look at the balance sheet and you see salaries payable or accrued wages of $1,200, you, as the informed reader of those financial statements, you know that that means the company has to pay that money pretty darn soon to its employees. Because I don't know about you, but most people wouldn't work very long without a paycheck. Do you remember that note payable, part of the initial capitalization of this coffee house? Well, guess what? We have to pay some interest on that. But maybe at the end of February, we just have not yet paid the interest. Perhaps it's due in March, or maybe it's the type of loan where we only pay interest for a period of time and then start to repay principal. Sometimes banks will structure loans that way, especially for brand new businesses. They let the company borrow money, and then for a certain period of time, maybe the first 6 or 12 months, the company only has to pay interest, and then they start to pay larger payments that reduce the principal in addition to providing some interest expense. So let's just assume that we got to the end of February and we have incurred interest expense of $100, okay? I like to think about interest expense as a form of rent, okay? Think about it this way. If you borrow $20,000 from a bank, you're renting their money. Just like right now, if you live in an apartment or if you lease a vehicle, you're borrowing that asset. Now, if you borrow an apartment and rent it, you call it rent expense. If you borrow money from somebody, you're renting it, we call that interest expense. So think about interest as really just being rent associated with borrowing somebody else's money. Rent expense, interest expense, in this case interest expense, needs to be $100 for the month of February because that is the economic cost for that particular month. In a future discussion, we'll look at interest in a whole lot more detail. But for now, just be assured that we need that interest expense for the month of February to get bigger. So we make a debit entry to that account. Remember, we have no cash to credit. We're not paying that right now. It goes into a liability. So what you're seeing here is just like in the previous transaction, we recorded payroll expense over here and then salaries payable. Same kind of thing is happening. It's just a different type of expense. We're increasing the expense for interest, and we're going to have a separate current liability called interest payable. That tells the user of the financial statement that there's an interest payment due very soon. I believe it was Benjamin Franklin that said, the only two things that are certain in life are death and taxes. And I got to tell you, that's true for corporations, just like for individuals. I mean, you file an income tax return every year, and you have to pay income tax on your earnings at your job. As companies earn profits, they have to pay taxes on those profits as well. Now, this is going to be overly simplified. You can get an entire master's degree in taxation if you wanted to go and study tax in great depth. But I just kind of want to simplify things here. So up to this point, I don't know if you've been following along, but we have revenues of $14,600, and our expenses up to this point have been $13,600. Now, profit is revenues minus expenses. And let me just label those. I want to make sure that we are all on the same page here. So revenues minus expenses equals our net income or our profit. You know, that reminds me, one of the things that can sometimes be confusing about the study of accounting is the terminology, and we do have synonyms. So yes, this is profit. We would probably actually call this pre-tax income or pre-tax profit, because the reality is we've generated this profit. That's the result of our operations for the month of February. But we're going to have to pay some income tax on that. Let's just assume, for simplicity's sake, that our income tax rate is 20%. And that's probably not too far off from the income tax rates that are in place right now as I'm recording this video. If you watch it at a different point in time, tax rates could be different. But the $200, that's what's going to be due to the IRS, really to the United States Treasury, associated with the profit that we generated for the month. So even though we're not going to spend this $200, we're not going to pay it to the United States Treasury just quite yet, we need to report this expense in the month and match it, really. We're trying to match this expense with the revenues and the other expenses that relate to that particular period. You see, most companies pay their taxes on a quarterly basis. Every 3 months they measure, well, it could get very complicated. I don't want to go down that rabbit hole, but they pay their tax bills often every 3 months, quarterly basis. So what we're going to do here is we're going to record the income tax expense. Here's another expense increasing with a debit, and that income tax expense for the month of February will be $200. Now, just like we did before, it's not going to involve cash. Cash is going to happen later in this instance. Maybe next month, maybe 2 months from now, we aggregate this liability and make one payment to U.S. Treasury. So for now, we have to put it in the liability. We have no other account to credit, right? Because cash is not going down, a liability instead increases. And let me just make sure we know that. This is a liability. It's really a current liability, let me put it that way, because I'll guarantee you, if you don't pay your tax bill within the next year, you will start to receive love letters from the IRS. They will try to get their money. So income tax payable, in this case, is a current liability. And then this is an expense that will be reported on the current month's income statement. You may recall that at the beginning of this discussion, we started with the unadjusted trial balance. And there were lots of zeros there. And there were other accounts where we needed to kind of tweak those accounts. What I wanted to illustrate to you is that here's the unadjusted trial balance. Here is the adjusted trial balance. So this is the collection of accounts and their related debit and credit balances after we made those adjusting journal entries. Now, some accounts stayed exactly the same. Take cash, for example. None of the adjusting journal entries that we prepared affected cash. And they shouldn't. That's one of the takeaways. Adjusting journal entries rarely involve cash because the day-to-day transactions record the cash activity. And then at the end of the period, we need to make adjustments for some of the other accounts. And cash probably doesn't get adjusted, maybe unless we forgot to record some bank fees, or maybe our bank made an error or something like that. But it's not unusual to see cash be the same balance from unadjusted to adjusted. But you will see that many of these other accounts, their balances got tweaked, okay, on the balance sheet or the income statement. Let me just illustrate with prepaid rent. So at the beginning of the period, or at the end of the period, unadjusted, I should say, we had prepaid rent was $7,200. I've underlined it there. You see it over here in the trial balance. Well, we made a journal entry to reduce that prepaid rent, and the ending balance, adjusted balance, is now $4,800. Similarly, rent expense in the unadjusted trial balance, it was zero. We know that's not accurate. It costs something to occupy space. We needed to turn that rent expense into an amount that reflects the cost of occupying that space for the period. And you can see that the ending balance for the rent expense account is $2,400, as we see right here. So all we're doing is we're taking the T accounts and their final balances at the end of that period, transferring them over here. This is our adjusted trial balance. And what we'll see is the adjusted trial balance gives us the building blocks for preparing the 4 basic financial statements. You can see that basically if we go from cash right down here through accumulated depreciation, that's all of the assets on this side of the balance sheet. So you can start to get a sense where we can use this information here to build the balance sheet at the end of the period. The remainder of the balance sheet is here from accounts payable right down through retained earnings right there. And you can see the accounts payable down through retained earnings here. But you might be, if you're paying attention, you might notice here and say, Chris, trial balance says retained earnings is 0. Your balance sheet says that retained earnings is 800. Those numbers don't match. And I agree with you, they don't match. But what you have to keep in mind is there's a whole lot of income statement activity here. We've got revenues right there. We've got our expenses right here. Remember that pre-tax profit was $1,000, right? So pre-tax profit before we recorded an accrual for income tax was $1,000. Then we recorded that provision for income taxes of $200. That means that our net income for the month of February is going to be $800. If we were to prepare an income statement, which we will do in the future here, these income statement accounts would produce a net income of $800. And that's what you're seeing right here. The earnings of the company thus far have been $800, and they've all been retained within the organization. In other words, we haven't issued any dividends or distributions to our shareholders. We've retained those earnings. In the future, we may pay a dividend, we may pay a distribution, and that will reduce the retained earnings. More on that in a little bit. Just a couple of final notes regarding adjustments. I know we already talked about this. Adjusting entries rarely involve cash accounts. They could if we needed to make an adjustment to cash to make it accurate, but they don't usually involve cash accounts. And adjusting journal entries usually include one balance sheet and one income statement account. That's not to say that we couldn't be reclassifying something from one balance sheet account to another or from one income statement account to another, but a lot of times it is a balance sheet account going up or down and a revenue or expense going up or down. as we saw with a lot of the entries that we recorded in this video.